What if I told you that the fastest way many people become millionaires is during times when the economy is falling apart? It sounds completely wrong, because when you hear the word recession, what comes to mind? Job losses, market crashes, businesses shutting down, fear everywhere. Most people see recessions as periods of destruction, times when wealth disappears and financial security becomes uncertain. But here is the uncomfortable truth. Recessions don't destroy wealth, they redistribute it. And while the majority of people are focused on protecting what they have, a small group of people are quietly positioning themselves to gain more. They are not panicking. They are not running away from the market. They are moving in when everyone else is running out. And this is not just a rare occurrence. It has happened again and again throughout history. During the 2008 financial crisis, when markets collapsed and fear reached its peak, some investors were buying assets at prices that seemed unbelievable. During the dot-com bubble crash, when people believed technology stocks were finished, a few individuals were quietly accumulating shares in companies that would later dominate the world. Even in the COVID-19 pandemic, when uncertainty shut down entire economies, those who invested during the panic experienced one of the fastest recoveries in market history. So the question is not whether recessions are dangerous. They are. The real question is, why do some people come out of these crises significantly richer, while others struggle just to recover? Is it luck? Is it insider access? Or is there a pattern hiding in plain sight that most people simply fail to recognize? Because if you look closely, you will notice something powerful. The same event that causes panic for the majority creates opportunity for a minority. The same falling prices that scare people away attract smart investors, and the same uncertainty that freezes most people becomes the perfect environment for building long-term wealth. This is where everything changes, because once you understand what is really happening during a recession, your entire perspective shifts. You stop seeing crashes as something to fear, and you start seeing them as moments to prepare for. In this video, we are going to break down exactly how recessions create millionaires, why most people miss these opportunities, and how you can start thinking differently the next time the economy takes a hit. Because the next recession is not a question of if. It is a question of when. And when it comes, it will either become your biggest financial setback or your biggest opportunity. Most people believe recessions are times when you should do one thing and one thing only: protect yourself. Save cash, avoid risk, stay away from investments, wait until everything becomes safe again. At first, this sounds smart. If the economy is unstable, why would you take risks? If markets are crashing, why would you put your money in? But this mindset is exactly what prevents most people from ever building serious wealth, because by the time things feel safe again, the opportunity is already gone. Let's break this down. When a recession hits, fear spreads quickly. News headlines focus on worst-case scenarios. People see their investments dropping in value. Businesses start cutting costs. Layoffs begin. And naturally, people react emotionally. They sell their stocks to avoid further losses. They cancel investment plans. They move their money into cash and wait on the sidelines. This reaction feels safe in the short term, but in the long term, it creates a major problem. Because while they are waiting, prices are falling. And falling prices are not just losses, they are discounts. Imagine a strong company whose stock was priced at $100. During a recession, due to panic and uncertainty, that same stock drops to $60. Most people look at this and think, this is risky. What if it falls more? So they do nothing. But what they fail to realize is that they are being offered the same asset at a significantly lower price. Now here is where the real mistake happens. When the economy starts recovering, confidence slowly returns. News becomes positive again. Markets begin to rise. And suddenly, the same people who were afraid before start investing again. But now, the price is no longer $60. It is back to 90 or even 110. So what do? They buy high, after avoiding the chance to buy low. This is the exact opposite of how wealth is built. And this pattern repeats in almost every recession. People sell when prices are low because they are scared. Then they buy when prices are high because they feel safe. It is not a lack of intelligence. It is a lack of understanding and emotional control. Meanwhile, A small group of investors sees the same situation very differently. They understand that recessions are temporary. They understand that markets move in cycles. And most importantly, they understand that fear creates opportunity. So instead of asking, how do I avoid losing money? They ask, where is the opportunity right now? That shift in thinking is what separates those who struggle financially from those who build wealth during the exact same economic conditions. Because the real problem is not the recession itself. The real problem is how people respond to it. To understand how recessions create millionaires, you need to shift how you see what is actually happening. A recession is not just an economic slowdown. It is a moment when prices and reality disconnect. In normal times, asset prices are driven by confidence. People expect growth, stability, and profits. So they are willing to pay higher prices for stocks, real estate, and businesses. But during a recession, that confidence disappears. Fear takes over. And when fear dominates the market, people start selling, not because the asset has become worthless, but because they are uncertain about the future. This is where the opportunity begins, because price is what you pay, but value is what you get. During a recession, prices often fall much faster than actual value. Let's simplify this. Imagine a strong company that earns consistent profits, has loyal customers, and a solid business model. Before a recession, its stock might be priced at $100. Now fear enters the market. Investors panic. Selling increases. The stock drops to $60. Did the company suddenly lose 40% of its real value overnight? In most cases, no. Its factories are still running. Its customers are still buying. Its long-term potential is still there. The only thing that changed is how people feel about the future. This gap between perception and reality is where wealth is created. Millionaire investors focus on this gap. They look for assets that are temporarily mispriced due to fear. They are not trying to predict the exact bottom of the market. That is almost impossible. Instead, they focus on buying good assets at better prices. Over time, as the economy stabilizes and confidence returns, prices begin to reflect reality again. And when that happens, those discounted assets rise in value. That is where the gains come from. This principle works across different types of investments. In the stock market, investors buy shares of strong companies when prices drop. In real estate, properties become cheaper because fewer people are buying. In business, struggling companies can be acquired, improved, and scaled when conditions recover. There is also another powerful factor at play. During recessions, central banks often lower interest rates to stimulate the economy. This makes borrowing cheaper. Smart investors use this to their advantage. They use low-cost debt to acquire valuable assets at discounted prices, increasing their potential returns when the market recovers. But this does not mean blindly investing in anything that looks cheap. Some companies fail permanently. Some industries decline for years. This is why strategy matters. Millionaire investors focus on quality. They choose assets with strong fundamentals, resilient business models, and long-term growth potential. And most importantly, they have patience, because the real profits do not come from buying during the recession. They come from holding through the recovery. This is the simple but powerful mechanism behind how recessions create millionaires. Not by luck, but by understanding how price, value, and human psychology interact during times of fear. One of the clearest real-world examples of this principle comes from the 2008 financial crisis. During this period, the global economy was under extreme stress. Major financial institutions were collapsing, stock markets around the world were falling rapidly, real estate prices were dropping at a speed many people had never seen before, fear was everywhere. People were losing jobs, businesses were shutting down, investors were pulling their money out of the market as fast as possible. For the average person, this felt like the worst possible time to invest. But for a small group of investors, it was one of the greatest opportunities of their lifetime. One of the most famous examples is Warren Buffett. While most investors were panicking, Buffett was doing the opposite. He was investing billions of dollars into companies that were temporarily undervalued. At the height of the crisis, Buffett invested in companies like Goldman Sachs and General Electric. Now think about that. These were not small or unknown companies. These were major institutions facing short-term uncertainty due to the crisis. Most people looked at them and saw risk. Buffett looked at them and saw value. He understood that while these companies were struggling in the moment, their long-term potential remained strong. So instead of avoiding them, he negotiated deals that allowed him to invest at highly favorable terms. Over the next few years, as the economy began to recover, these investments generated massive returns. Buffett made billions of dollars from decisions he made during one of the most uncertain times in modern history. But here is the important part: this opportunity was not limited to billionaires. Thousands of ordinary investors who followed similar principles also benefited. People who invested in broad market index funds during the crash saw their portfolios grow significantly over the next decade. Real estate investors who bought properties when prices were low experienced strong appreciation as housing markets recovered. Even small business owners who started or expanded during the recession found themselves in a much wronger position when the economy stabilized. The pattern is clear. While the majority was focused on avoiding losses, a minority was focused on capturing opportunities. They bought when prices were low, they held through uncertainty, and they benefited when the recovery came. This example shows something powerful. Recessions do not just create problems, they create opportunities that only become visible to those who are willing to look beyond the fear. So what is the real lesson behind all of this? Recessions are not random disasters that only bring destruction. They are predictable cycles in the economy that shift money from one group of people to another, and the biggest factor that determines who benefits is not intelligence, background, or even starting capital. It is behavior during fear. Most people react to recessions in the same way. They panic, they retreat, they wait for everything to feel safe again before making any financial moves. But by the time the environment feels safe, prices have already recovered. The best opportunities are already gone. This is why so many people feel like they are always too late in investing. They wait for confidence, but wealth is not built in confidence. It is built in uncertainty. The people who build wealth during recessions understand a few key principles. First, they understand that markets move in cycles. What goes down eventually comes back up, especially when it comes to strong economies and strong businesses. Second, they focus on value instead of emotion. They do not ask, is the market scary right now? They ask, is this asset worth more than what it is currently priced at? Third, they think long-term. They are not trying to get rich in a few weeks. They are positioning themselves for growth that happens over years. And finally, they stay patient. They know that the real reward comes after the recovery, not during the panic. This mindset completely changes how a recession looks. Instead of seeing falling prices as danger, they see them as discounts. Instead of seeing uncertainty as a warning, they see it as an opportunity window. Instead of following the crowd, they learn to think independently from it. And this is the real separation between those who struggle financially and those who build wealth. Because wealth is not just about income. It is about how you behave when everyone else is afraid. The truth is, recessions will keep happening. Economies will always go through cycles of expansion and contraction. You cannot control that, but you can control how you respond to it. You can choose to react emotionally like the majority, or you can choose to prepare, learn, and position yourself like the minority who benefit from it. That is the real lesson. Recessions do not create millionaires by chance. They create millionaires through perspective, patience, and preparation. And the next time the economy slows down, the difference between fear and opportunity will come down to how you choose to see it. If you want to understand how money really works, how wealth is actually created, and how people build millions while others struggle during the exact same economic conditions, then you are in the right place. Because the truth is, financial success is not just about working harder. It is about thinking differently. And if you keep learning how money moves, how markets behave, and how opportunities are created during chaos, you will always stay one step ahead. So subscribe to The Geeky Investor, because the next recession will not wait for you to be ready.